On your marks, get set, invest. Investment guides generally focus on what to buy and when to buy it. Novice investors often spend most of their time researching investments for that purpose, and that's good, but it's only half the battle. Whether you have an appetite for low risk, medium risk, or high risk investments, you need to give plenty of thought to when to sell as well. Now, some finance gurus say you should just choose a promising investment and buy and hold it for decades before eventually cashing in. But the success of that strategy varies enormously. Back at the turn of the millennium, if you'd bought a fund tracking the performance of the S&P 500 index of top American companies, you'd have more than tripled your money by now. But as we saw back in episode 1, if you'd bought a fund tracking the performance of the FTSE 100 index of British leading companies over the past 20 years, you'd have made almost no profit at all, even if you'd reinvested all the dividends that the companies paid you. The 3% per year you'd have made has been eaten away by inflation. In other words, you'd need that 3% just to keep up with rising prices in the shops. But 20 years ago, a lot of British financial advisors were telling us to put the lion's share of our money into British and not American shares. So many British investors have not enjoyed the performance they'd have hoped for. This is why it's so important to check how your investments are doing, even if it's, say, only once every few months. Then you can ask yourself or your independent financial advisor why some of your investments just aren't doing as well as expected, and whether it might be time to sell. That's why it's important to bear in mind that sometimes it may be a good idea to just call it quits and try something else, a different investment. Remember, the most important thing to do if you find yourself in a hole is just to stop digging. Don't throw good money after bad. If you want to continue holding a lackluster investment, you really need to be able to justify it with really strong reasoning. The first thing to do is to think back to why you invested in that share or that fund in the first place. It's good practice to make notes when you initially invest, because months or years down the line, you might not even remember why it caught your eye in the first place. So the question you need to ask yourself is, do the reasons you first invested still apply? And if not, why are you still holding it? Would you buy it now if you were investing for the first time? Well, maybe it has different management now. Do they still seem as dynamic and clever as the old management team? Are profits and sales still growing as you expected? Are you happy with the dividend yield? If the answer to any of these questions is no, then you need to have a serious think about whether you should sell it. The important thing is never to get wedded to a share. It's not your life partner, it's an investment, and it's there to make you decent money. If it's not doing that, then just feel free to break your vows whenever you like. But wait! On the other hand, you don't want to be too hasty in ditching your investment either. Maybe it's just going through a brief, difficult period, as businesses sometimes do. The important thing is to look at the future outlook for the company, even if this year's figures look a bit drab. You can find the CEO's outlook in the company's latest financial results document, as we discussed in episode 3. You might also want to read articles on major news sites like these. But bear in mind, these are just the opinions of the journalists and the industry analysts who they interview. Informed opinions, usually, sure, but still just projections of an uncertain future. Sometimes they're proved right, sometimes wrong. So just take it with a pinch of salt. Another good reason to sell is to rebalance your portfolio. Let's say you own shares in Meanpot, Utility plc, and Green Future plc, and you invest £2,000 in each of them. But while two of the companies grew modestly, Green Future shares have rocketed in value and they're now worth £12,000. This is great news, of course, but it leaves you with the rather delicious problem of having one share now making up the bulk of your portfolio. So if this one share crashed, you'd lose a lot of your money all in one go. Unless you're a very high-risk investor, that is something you're going to want to avoid. So what you can do is cash in some profits by selling some of your Green Future investment, perhaps a half of it, or even more. And you can then use the £6,000 that you've pocketed to buy 2 more shares that you've had your eye on at £3,000 each. Now, as you can see, Green Future is still dominating the portfolio to some degree, but not so dramatically. Of course, you can sell half again and invest the £3,000 in another share so that all your investments are equal. But many people like to hang on to a sizable chunk of their biggest winner, which is understandable because that's how investing fortunes are often made, by riding your winners as far as they go. So the aim is to keep open the possibility of big gains while also avoiding heart-stopping declines in your personal wealth, which can feel devastating both financially and emotionally. We talked in episode 4 about opportunity cost, how when you invest in something and it doesn't make you any money, then you've lost out on the opportunity of investing that same money somewhere more profitable. Let's say as the years pass, all your shares are rising fast, except for one, Utility plc, which just goes sideways or downwards year after year. People often have a strong urge to hold on to shares like this, even if they could be making a lot more money by selling Utility plc and investing in something else instead. When we've put a lot of time, money and effort into researching and investing in something, it can be really difficult to admit to ourselves that it just hasn't paid off, and maybe it will never do so. That makes us feel like failures, and we hate that feeling. So we tend to ignore those shares and just let them fester away in the vague hope that one day they'll go back up again. This is a very common situation for investors. Unfortunately, many of us don't just do this with the odd share, we do it with our entire pension portfolios. A survey showed that most people pay little or no attention to the investments inside their pension fund. This is often disastrous for people who reach retirement only to find that their pension pot is inadequate for their future needs. Ignoring the problem does not make it go away, medium risk. If you own a share and the price chart looks like this, you need to ask yourself some hard questions. Have profit and revenue expectations improved so much that you expect the price to take off soon? Is the annual dividend so juicy that it's worth holding on to the shares even if the price never goes anywhere? And if you didn't own the share, would you want to buy it now? One last piece of advice for long-term investors. It's great when your share you own does this. A great performance. But it's really not great when the same share goes all the way back down again. In fact, it's downright depressing. So how can you avoid this trap? Sometimes the price drops very suddenly with little warning, perhaps because the company announces it's in deep trouble. For investors without a crystal ball, there's little they can do to avoid that. But often, the chart does provide warnings. I saw one of these warnings in early 2008. You may remember that was the year of the great financial crash, when the Wall Street firm Lehman Brothers collapsed, which caused a huge stock market crash. It happened so suddenly. Who could have anticipated that? Well, I did. Look at the S&P 500 index of American leading shares, all looking good up until late 2007, but then, I'm not sure about this now. Perhaps too early to panic still. By this point in mid-2008 though, I was pretty certain that all was not right. Just look at it, that smooth upward climb is over, right? That's what I felt. And I'd been slowly selling my shares during the months prior, as had many Wall Street professionals, which was precisely what was slowly pushing the market down. And then this happened. A lot of investors were caught with their pants down, but the warning sign was there for those who were paying attention to the chart. A faltering price chart doesn't necessarily mean you should always sell everything. It's just a sign that the risk level may now be higher. And that's true of a market or an individual stock. There are plenty of times when it looks a bit dicey, but then it recovers and goes higher. It's just one of many factors to consider when deciding whether it's time to sell. So just make sure you've considered the fundamentals and the whole picture. And if you're really worried, remember you can always sell some of your investments, then just wait till you feel more positive. I've updated your research, and then you can buy them back again if you like. The key thing to remember is that nothing goes up and up forever. Even the greatest corporations in history have mostly been reduced to dust eventually. Every share and every fund should be considered a temporary holding. But temporary can sometimes mean years or even decades. So don't be in a hurry to sell, but don't hold on for no good reason either. The key is try not to get too emotional about it. Instead, focus dispassionately on the hard facts about the company and about its share price. And medium risk, old buddy, you will make it.